Hey guys, what is up? It's Arthur here, and in this video we're going to take a look at SoFi Technologies, ticker symbol SOFI. And this company was a suggestion. It came up in a discussion under a previous video where it was suggested that we take a look at the Lending Club, which was the previous video. There's going to be a link at the end of this video to that, and it was mentioned that they might have some similarities. So while we were at Lending Club, I decided that let's just do SoFi as well, and let's see what we can find. If you don't know, SoFi Technologies is a financial service platform which engages in the provision of student loan refinancing options to the private student loan market, the good old student loans. We have lending technology platform, financial services, personal loans, student loans, home loan products, and related servicing activities. Right. So basically, I think this is also a service platform. So I think we're not going to have brick and mortar. So in that sense, it might be like Lending Club, just a purely digital service. Anyway, let's get into it. We have our trusty dashboard, and what we can see, the company size is 14.72 billion, as you can also see on the card, which is about 13 times as much as Lending Club. So there is a size difference there. We can also see that just at a first look, this looks a little bit more healthy. Let's see what we can see. Gross profit margins are not going to be here because financial companies report their financials in a slightly different structure. I am not that familiar with financial companies, so if you are more into them, let us know in the comments and share some of your insights, because I love reading your comments. Now, profit margin in the past 5 years was minus 8%, but they managed to make that up all the way to 12, which is good. I think it is higher than what we saw at Lending Club. I'm not sure, but I think it is. We have no dividend, although there were some paid. So it might have been cut, I'm not sure, but it doesn't seem too big anyway. There might have been more previously. We're going to take a look at that. There are no purchases, although this might be because they listed as a slightly different line item. So let me just quickly check. It's going to be in cash flow, and yeah, they do have some, it looks like. But anyway, let's not get ahead ourselves too much. Let's focus on the first things. Now that we know what the size of this company is, we want to take a look at their revenues, how much money they are bringing in and whether that has grown. So we're going to go into the financials, and we can see that we are up from 750 million to 3.7 billion. This is a really nice check mark. This is a 5x, and it's lovely to see. This is a very nice sort of exponential growth, if you can see the trend line there, the trend itself. So this is very nice to see. Early on, it's easier to produce larger increases as a company gets bigger and bigger. Looking at the market cap right now, it's harder to make these type of gains. So this is more common in smaller companies, but it is very nice to see. Now, the next item we want to see is that the net income should also be growing with it. So this is what the company brought in. We deduct all the expenses, and then we arrive to net income. And we went from losing 224 million to making 500 million. So that's also a very nice check mark. Lovely to see that they are actually making money, because in the, not counting 2024, the 4 years prior to that, they were just losing money. And now if you know these numbers, you can calculate the average of that. which is losing $166 million every year. And I use the average of this 5-year net income to take the market cap, divide the two, and get the PE ratio, which is going to tell you if you buy this company right now at this share price for this amount, so you're just buying the whole company, this is how many years it will take you to make your money back. Now, unfortunately, this is a negative number, so that's an X. We cannot really interpret that. But since the last year it made money, what we can do, this is the back end of the list that you see. So this is sort of the control room. And for net income, we see that we have all negative numbers. Well, we can take this, and if we just put that in there, the PE ratio updates, and now we have a 29.5, which is still an X. It would make it more expensive than a 20 multiplier, 20 years, because any company above 20 is thought to be expensive. Around 15 to 18, it's okay, and below 12 is where things get cheap and of good value. Now, another metric that I brought in, and I like the idea of it because it makes you look around this company, is that we're gonna take a look at the industry median PE ratio, which is basically just taking a look at other companies and seeing how expensive they are. So this is on TradingView, a site that I love, and I found that it has these breadcrumbs. You can click on second to last, which is like the most niche sort of grouping of companies, and it's going to show you competitors, which is fantastic. There's a ton for SoFi. I hope I pronounced that right. And probably Lending Club is somewhere in here because the list looks familiar. It was no, I think it was major banks there, so it might be different. But anyway, we have the PE ratio column here. So what the median does is that it puts them in increasing order, and you're just gonna take the middle value and see how that compares to SoFi. And in that case, assuming that we're only using the last year, it is still more expensive than the median of 11.5 years of making your money back. So there might be better deals out there than this. Now I'm just gonna delete these because it is technically an X. And it changes that second card as well. So let's just get back here, keep those X's, because let's remind ourselves that it has been losing money in 4 out of the past 5 years. So that's not something to forget. And then because these financial companies report their financial statements in a different structure than what I see and analyze in most cases, my calculation cannot give you a value for the return on invested capital. This is also because this is not a generally accepted metric. So different sites, different analysts use different formulas for return on invested capital to calculate that, and probably can find one value on MarketWatch, which is 4.82%, which is higher than Lending Club. Lending Club was 3.86, so this is a percentage point higher. But the market average is 9 to 10%. That's why I'm looking for over 10%. So this is still half the market's average of how much money they make on every dollar that is put into this business. So if $1 is put into this business, they're going to make 9.82 cents, while an average company would make you 9 to 10 cents. So this is a difference. This is a big difference, and it's under the market average, but slightly better than Lending Club for what it's worth. Now, another big one that I love is taking a look at the number of shares that are outstanding. You can do that by going to the financials, and in the income statement, where you know how much money the company brings in, deduct all the expenses, how much is left, you're going to see how many ways you have to distribute it. There is basic shares outstanding, which you can take a look at, or diluted shares outstanding, which I use because it also includes convertible options and like stock options for like employees, and if some companies can change their debt, or like they're lending into shares or other kinds of things, which basically wasn't the case in earlier years. It only became a thing here. Usually these numbers are not really far apart, but I just use the larger number, which is diluted shares outstanding, because that's the worst case that can happen, and I like to be a little bit more conservative. So what we can see here is that we went from 74 million up to 1.1 billion shares. I have no idea what happened here, but we basically 15x'd the number of shares. This is tragic. I don't know really what happened here, what kind of share issuing they went into, but like imagine you buy the company here, I don't know, let's say you buy a ton of shares, you own 10% of the company, and then all of a sudden 5 years later you did nothing, but they issued a ton of shares, there are a ton of new owners, and if here you were owning 10% of the business, here this is more than 10 of it, so you would not even own 1% of the business. So they just took away your like investment in the business and just reduced it by like a 10th or like 15th, because it's a 15x. So if you own 10% prior, you now own 0.5%, I think, which is just insane to think about. I don't know what happened here, but this, I would really have to look into if there's a good explanation into that. But just seeing share prices skyrocket into astronomical values is really that I would just, if I don't see why that is, if there's really not a good explanation for this, I'm just out. I'm like, call me out. I'm out of here. So I really suggest you look into this if you're interested in SoFi, because this is a huge X. So next up is what you can see on the 7th card. This is the increase, the rate their long-term liabilities increased over the past 5 years, and how much their revenue managed to increase in the same time period. So we know revenue increase, it's in the first card, it's 400%, which is nice, we love that. So let's see how much debt they needed to do that. And ideally you would want less, so it would mean that they made more of what they have. The way you can do that is you go to the balance sheet, where you have basically assets and liabilities and shareholders' equities. Really simply put, what the company has and how they can afford it. That's the sauce of it. So you're going to go into the liabilities section. There's total liabilities, but notice that we're looking for long-term liabilities. Now that is not listed. At other companies, this is well better structured. I like that more. What we can do here is that we can take, it's just total that, and for the current section, because total liabilities is made up of current liabilities and long-term liabilities. Current meaning it's due within 1 year. Everything else that's on a longer time horizon is long-term. So what we can do is we can deduct short-term debt and the current portion of the long-term debt that is also due within 1 year. We can deduct this from total liabilities, and you do that for every column. You take the increase from 2020 to 2024, and you would get 450% of increase, which is higher than the 400% you managed to do revenue-wise. So this is an X, because you took on more debt and you were not able to produce the same increase in terms of the money that the company is making. So you would also want to look at why they took on so much debt, what they use it for, because it might happen that these debt that they took on does not have the same time horizon in terms of playing out as revenue would show. What I mean by that, these debts might have been taken on to build a new office, or I don't know, build some kind of factory, or build some kind of brick and mortar store, or more of them that would start returning you more money beyond the given year or beyond this 5-year time period that we're looking at. So you would want to open, for example, their 10K, which is the ultimate sort of thing, like 100, 150, 200 pages long document where they talk about every single item in here, what it includes, what it doesn't include. And so you would have a better understanding of what these debts and liabilities are meant for and what are their expectations from making these and putting them on the balance sheet. So that's something you would have to look at. Now, free cash flow wise, the last 3 cards talk about free cash flow, which I absolutely love because that is the bread and butter of a business. It's way harder to manipulate than net income. So you would want those two to be together, not too far apart, because that would indicate something's fishy. The way you can get free cash flow is you take net operating cash flow and then you add the negative numbers of capital expenditures to it. You can do that by column, or MarketWatch gives it to you if you scroll down. So we actually went from 12 million to 1.11 billion, which is very nice to see. There was a year where we lost money, but this is a huge increase. This is, I don't even know, is that 93x? But it is very easy to grow a small number into something bigger and achieve this high number. So if we were to do a discounted cash flow analysis, which would help us put a price on this company, this would be a little troublesome because the company is still small. We're just almost $15 billion in a market cap. And like 40 years ago, the company I assume was a lot smaller. So then what kind of numbers do you work with? Do you take the average of this, but then the last 2 years are way, way bigger than this? There was also more growth here. There was a negative number. So it's a bit difficult to judge, but the average of these 5 numbers is $300 million, which is nice. It is also higher if you look at the right side at the checklist. We have on the second card the average of the net income, which was a minus 170 million roughly, only positive in the most recent year. So at least free cash flow is more often positive, which is a big check mark. It's a huge positive. We love free cash flow can be bigger than net income. That's not a problem. It's just fishy when net income is higher than your free cash flow. But free cash flow being higher, yeah, we take that. And so we can use this number to again take the market cap of 14.72 billion and divide the average amount of free cash flow that the company is making. So you get again a year number of how many years it would take the company to make your money back. And that is 95 years, which is an X. So compared to how expensively you don't know if it's expensive. So compare, you would have to pay $14.72 billion for the company to own it outright 100%. And it would only make you $300 million every year, right? So you can see there is a big difference, and the difference is 95 times. So that it would take you 95 years to make that money back. So, sorry, that is not the correct value that I was aiming at. This, sorry about that. That's going to be the next metric. So I'm going to show you that. That is an X, which is 47. So this is still would take you 47 times for the company to earn the purchase price back in terms of free cash flow, which is still not good. You would want that to be over below 20, because above 20 is expensive. And what the 95 was, if you were a little hawk-eyed, you could read that. The title is we're going to take the long-term liabilities that we calculated here. So you would have that number. You just take the most recent year, and then you're going to divide by this 300 million. That would give you how many years you need to pay down the debt. And that is 95 years. And you would want that to be under 5. Like, you see the problem. You have a ton of debt, but you're not really making enough cash to pay it back. So if we go back, we can take a look at, before we leave, in the most recent financial year, we made $1.1 billion in free cash flow. If we go to the balance sheet, we can see that the total liabilities is almost $30 billion. So just that would take us, with the most recent highest free cash flow number, would even take us, what, 25 years to pay that down? And there is this thing that you can use free cash flow for 5 things. So all these 5 things have to share on the same amount of cash flow. You can reinvest in the business, you can pay down this huge debt, or you can buy other companies, you can issue it as a dividend, or buy back shares. And now you would need 25 years with the current most recent free cash flow number, just if you use that for paying down the debt and you have not reinvested a single cent in the company. So this is a huge problem. Usually I don't see such high numbers for these debt repayment in years. That's why I was confused for a second and mistook it for the next value. But again, I don't analyze financial companies a whole lot, but I don't know how these play out, but this is what we managed to gather up. So this is a 3 out of 9 or 3 out of 10 if you consider the roughly 4 to 5% return on invested capital that we saw in the profile, 4.82%. And since this company has some form of a positive free cash flow, we can do a discounted cash flow analysis on this. What this means is that we're going to take a look at how much free cash flow they're making. We're going to assume a growth rate for what rate that free cash flow is going to go in the future, in future years to come. And then we're going to bring it back to today's value, because $100 10 years from now is not going to be worth the same as 100 years today. If you just think about how much you can buy for $100 versus how much you could buy for $100 10, 20 years ago. It's not the same. So there is this time difference that we're going to account for. And here we have to make a ton of assumptions. So this is going to be very different for everyone. We're just going to see one value, and we really have to think about what makes sense here. These numbers, as I mentioned earlier, are kind of hard to use as a basis, because the thing is, the company was very small here, like tiny free cash flow, grow into a substantially larger amount. But what this means is that you have a gigantic compound annual growth rate, which you really cannot use going forward, because the company is not going to triple free cash flow or earnings or anything every single year for 10 and so on years, 10 plus years. So that is not really reasonable. You could make that, the company would come out as worth, I don't know, $1 billion. So yeah, go ahead and buy it. But that's not really how you should do it. As I mentioned, I like to be more conservative. So, but again, the numbers are so small and the growth is so big that I think we're just gonna make something up. The free cash flow basis, I think we can use the average 312 million. I could use, because it is a lot smaller than the current one, so it's more on the safe side, but there has been negative years in the previous years. So I will take that. Now this here, we have to do something to correct this, because this is just too much for my liking. And I think a company cannot grow this fast. This is sort of not a huge company, but a decently sized one. So you could go and look at the market cap, companies with a market cap of around 15 billion, and you could see like what percentages they have been growing yearly. So that would give you an idea of what are the growth possibilities here. I'm just gonna assume, let's say they grow 30% from now on every year. So next year they would be 1.5 billion, then 1.8, I don't know, something like that. And then in year 6 to 10 in the future, is there's going to be half of that because they can't forever grow with that initial rate. And then it's going to project that into the future. I'm sorry, it's not going to make 1.5 because we used a smaller number just to be more conservative. We're just going to go off by this number just in case anything happens. And this was like a very outlying year. And this is more in line with what they're capable of doing. So taking it more conservative there. So you would start with 312 million now. Next year they make 406, 528, 686, and so on. You do this for the next 10 years, and then you just take a number to infinity. There's a formula for that. And then you're just going to discount it, bring it to today's value. You're just going to sum it up. This is how much it worth. You're going to add the cash that they have, deduct the total debt, and that would give you that the company is worth roughly 11 billion. Not a big change. And then comes the magic trick. You divide by the number of shares and you get a number of how much this company is worth. And there you have it. It would say us that the intrinsic value is $9.96 per share. Currently it's 13.17, which is a difference of $3.21. So it's a minus 24.4% that you could earn on it. So you would lose money on this in this analysis and using these assumptions. But if you have noticed, we used a ton of assumptions. Like I didn't use the last year's number. I didn't even use the year prior to that. I used something that's lower. I didn't use the growth rate that they have been producing. I used a much lower one. So it really comes down to your assumptions. If you use just, I don't know, a third of what they managed to do last year, and we do 50% and then half of that, then, you know, the share is worth a double of this, what they are currently selling for. But I don't really, and I, again, use this smaller number. But again, I don't really know, because this is sort of volatile and there is a lot of questions related to why they increased their liabilities, why they took on so much debt, what are their plans with it, and also just a ton of new shares outstanding. So that would make a problem for, you know, being an owner and really getting value out of this. So I don't know what would be the correct play on this. If you have an insight or you have your own take on this, let us know. Or if there is another company that you think we should do next, let us know and we'll be happy to take a look at it and spark some discussion to help each other out in that sense. I hope this was valuable for you. Thank you for your time, and I hope to see you in another video. Bye.